What is going on, guys? Nick here, back with another video. Going all the way back to the beginning, my first stock analysis video on this channel was actually Amazon. And at the time, the stock was trading around $2,700, and after that, it ended up rising all the way up to $3,500 before falling back down to about $3,100. And it really hasn't made any significant gains since. And spoiler alert, I actually think that this price stagnation is a huge long-term buying opportunity. If you're looking for a solid business with tons of growth potential that you can buy and forget, Amazon is giving you that opportunity right now. So let me explain why. So the first thing we need to discuss is the two major reasons the stock seems to be stuck right now. So the first major reason should seem pretty obvious. A lot of what drove the run from April to September seemed to be related to the shift to online shopping because of the in-person store closures, and Amazon obviously being one of the most apparent ways that people would start shopping online. Back in June 2020, during my first look, analysts forecasted Amazon to earn $37.56 by the end of 2021. But since then, those numbers have been revised, and for a pretty good reason. During the final 3 quarters in 2020, they blew away earnings forecasts. June was forecasted to earn $1.46, and they ended up with $10.30. September was forecasted $7.41, and they ended up with $12.37, and then in December they were forecasted $7.23, and they nearly doubled that with $14.09 per share. Now the revenue wasn't quite as big of a beat each time. In the June quarter they earned $89 billion versus $82 billion expected. In September they earned $96 billion versus $93 billion expected, and in December they earned $126 billion versus $120 billion. I think if these revenue beats had been bigger, we would have seen a lot more movement in the stock price. The second major reason I think the price is stuck, and I think this is probably the biggest, is Jeff Bezos, the founder and longtime CEO of Amazon, announced he will be replaced as CEO. Bezos will become the executive chairman of the company instead. This seems to have put some uncertainty into the stock. It's a big deal to replace the CEO that Warren Buffett called the most remarkable business person of our age. And it's not always a guarantee that the replacement will improve the company, even with the giant name brand Amazon. Sometimes CEO replacement can lead to some really lackluster financial performance, and I think of Microsoft under Steve Ballmer as a perfect example of this. I did a whole video on Microsoft, so if you're interested in seeing it, click the link in the description. But then there's also examples like Apple after Steve Jobs. How could anybody replace Steve Jobs? But Tim Cook seems to have done a pretty good job of that, to say the least. Andy Jassy will replace Jeff Bezos in the third quarter of 2021. Jassy has been running Amazon's most profitable business, Amazon Web Service, since its inception. Amazon's idea for Amazon Web Service came around 2003, after they were inspired by their own difficulties to build server infrastructure. Andy Jassy said that Amazon had realized it'd become very good at running infrastructure services like compute, storage, and database. Amazon is a retail business, and if you know anything about retail, it's a low margin business, which means that eliminating unnecessary costs is extremely important for their profitability. Amazon started to consider what would eventually become AWS. They could take their ability to build cloud infrastructure and sell it. For businesses, this solved the huge problem of having to build and run their own server infrastructure, as well as just having the technical capability to even understand how to set this up in the first place. But at the time AWS launched in 2006, that really wasn't the case. In hindsight, this seems like a pretty obvious service, but at the time AWS launched in 2006, that really wasn't the case. It actually took years for other companies to catch on and launch comparable products. And because of this head start, AWS was able to dominate the market early. They were able to use their head start to gain feedback from customers and fine-tune AWS for their needs. But eventually Microsoft and Google launched their own products Amazon would have to compete against. And even with competition from very capable tech companies, especially Microsoft, who specializes in enterprise products, AWS under Jassy holds a third of the entire cloud infrastructure market. Within Amazon, Jassy is known for his attention to detail, hands-on approach, and back-to-back meetings. In the past, Jassy has talked about it being very hard to build a business that sustains for a long period of time, and that businesses have to reinvent themselves over and over to maintain relevancy. This idea of maintaining relevancy sounds very Jeff Bezos-like. In the 2016 letter to shareholders, Bezos explained what he called the day one and day two concept. Companies should always be in day one mode. As companies grow, it becomes easy to rely on the process rather than the result. Day two is when a business becomes static, followed by irrelevance, and then an excruciating, painful decline, and then death. Think about Sears or Blockbuster when you think about day two mentality. Bezos says to stay day one, you're required to experiment patently, accept failures, plant seeds, protect saplings, and double down when you see customer delight. And in his opinion, a customer-obsessed culture creates the condition where all of that can happen. Andy Jassy, who graduated Harvard Business School in 1997 and went straight to Amazon, followed his same mentality when it came to growing AWS. I expect Amazon at this point to continue to innovate and expand under Jassy just as much as it was recently under Bezos. So let's take a look at how Amazon's business is actually performing. Starting with revenue, operating income, and net income, we see a business that has consistently grown its revenue each year, but has pretty small profit margins. Since 1997, Jeff Bezos has included in every annual letter a reminder that Amazon will continue to make investment decisions in light of long-term market leadership considerations, rather than short-term profitability considerations or short-term Wall Street reactions. This is their way of saying that Amazon doesn't concern itself as much with profit margins. It would much rather invest in things that will grow its sales numbers and improve their competitive advantage against other companies. When we look at their revenue versus expenses, we can see the cost of sales is the majority of their expenses, making up nearly half of their sales. I did notice that fulfillment increased disproportionately to their other services. Amazon said in their most recent annual report that the increase in cost is due to an increase in sales volume, expanding their fulfillment network, and disruptions in fulfillment centers due to the pandemic. Now, Amazon breaks itself down into three pretty straightforward categories: North America, International, and AWS. North America and International are their respective retail sales and subscriptions from each market. AWS is the cloud business segment the incoming CEO is currently in charge of. Looking at these segments, we can see that North America is the biggest segment in terms of sales, but AWS is actually the biggest profit contributor. Over the last year, North America profited $8 billion, International took $700 million, but AWS generated $13 billion, which is about 2/3 of all of their profits, while only accounting for about 12% of their revenue. When we look at each segment's revenue growth, it does appear that AWS, the profit generator, is slowing fairly quickly, but did report 28% growth over the last year. At the same time, North America and International have seen a huge spike over the last year. Now, this could suggest that profit growth for Amazon will slow down as AWS growth comes closer to maturing. But it's important to remember that Amazon is still mostly focused on sales growth, which is still doing very well. Now, this is where things get a little interesting with Amazon, trying to come up with a valuation. But before I get to that, if you found this video helpful, make sure you take just 1 second to scroll down and hit the like button. Now, the rest of this video is just my opinion and my own evaluation methods. If you have different methods or different opinions, I'm always interested in hearing them in the comments below. We can look at Amazon using two different ways to value it, either revenue or profits. The problem is when we look at the revenue, it's really North America and the international businesses that are really growing Amazon. AWS really doesn't contribute a ton to the overall revenue growth. When we look at revenue growth, the current forecasts expect $641 billion by 2023, but they're also expecting a pretty significant slowdown in overall revenue growth, with only 15% expected between 2022 and 2023. Amazon itself says that this is their main long-term focus, so it does make a lot of sense to value based off of this. But on the other hand, from my experience, valuations based off of price to earnings tend to match stock prices far more often. While revenue growth is projected to slow down, earnings are still forecasted to grow 13% from 2020 to 2021, and then 38 and 37% over the next 2 years. Usually businesses can only become so cost efficient, which is why looking at revenue growth is typically the best way to determine a business's overall growth. However, Amazon is much different. What grows revenue, the North America and international businesses, is not what grows their profits, which is AWS. So for this valuation, I'm going to stick with a relative PE valuation. For the PE, I don't think it makes sense to use the 37 to 38% growth forecasted in 2022 and 2023. I'm going to split the difference between revenue and earnings growth and use a growth rate in the middle of 26% for the top end number. For the bottom end, I'll decrease that number a little bit to err on the side of caution and use a growth rate of 22%. If you want to try this with different numbers, click the PE calculator in the description. 22% growth comes out to a fair PE of 63, and 26% growth comes out to a fair PE of 80. $1.88. Amazon over the past 12 months has earned $41.83 per share. This gives us a valuation between $2,677 to $3,681. By the end of 2021, Amazon is forecasted to earn $47.73 per share, which gives us a valuation between $3,054 and $4,200. Analysts currently forecast 2022 to earn $66.10, so this brings my valuation up to $4,230 to $5,817. Both of these numbers are currently well above the current share price. If we look at this on a chart, we can see just how good of a value this company currently is, with a 2023 valuation forecast between $6,000 to $8,000 per share. And if you've been watching my videos, with a lot of the growth stocks I've covered recently, this has not been the case. Most of the companies I've looked at are trading around a share price that the fundamentals won't support until 2022 or 2023. I think that Amazon's growth, combined with its strong competitive moat and track record for innovating and ambitiously growing the business, makes Amazon one of the best buys on the market right now. Unlike a lot of the high growth companies out there, Amazon has a proven business model, and I don't see them going away anytime soon. Now, I do own Amazon stock, and it's actually the largest position I own. As it sat flat over the last 6 months, I've even closed some of my long-term positions in Berkshire Hathaway and JP Morgan to transfer them to Amazon. I really believe in Amazon long-term as a great company for anybody to own, no matter what your investing goals are. Now, if you want to learn a little behind the scenes on how I do stock research, check the video in the corner where I'll walk you through the steps that I take when doing stock research. And as always, thanks for watching.